Welcome everyone to the Kendall Report. Missed you all yesterday. Life goes on here. What a crazy day. As a matter of fact, I should have warned you that whenever I'm away from the office, the markets go down. And beware if I go out of the country or on a trip, it gets even worse. So quite the day. We continue to see a deterioration. I mentioned in the last broadcast that what we're seeing here is what's called a full liquidation mode in our database. And that doesn't mean from the day I said we're going into that when we dropped under 22%, but that I've been talking about the deterioration of the short-term database going all the way back when we dropped under 42% and even before that. I'll go into more details here in a few minutes as we take a look at the database. But there is just and there's a lot of stuff going on. I saw somebody on the comments go, "It's ugly out there." It really is. And I don't think it's over. And one of the notes I put on here, I put on here a couple things. The title for tonight is Market Losing Confidence, or Markets Losing Confidence. And I think that's happening, especially when you have Joe Biden out there, touting this massive increase that will bankrupt the auto companies, not to mention that the EVs are already bankrupting Detroit, what's left of it. There's no money being made. Ford's losing billions, I think 4.5, almost $5 billion on trying to make electric trucks that nobody wants. And so, and then you got Biden out there trying to get them a raise. I mean, what are these people doing, folks? Help me out here. Please make some comments here. I need help. I have no idea. I'm watching, theoretically, I'm an older man, been around a long time, seen a few strikes, actually participated in one when I was in college at United States Steel. We went out on strike. Actually have strike stories that occurred back in the day. But never would a U.S. president or anyone take the side, either side, the company or the workers. And now we've got Biden out on the picket lines, folks. This is, I guess, there's another 16 months to go to ruin the country. I mean, help me out. Not really a political statement, just reality, folks. One of the things that I have mentioned before, and probably end up after missing a day, end up on some mini rants here. But one of the things, I'm the guy that you guys have watched for months on end, telling you there's not going to be a recession. I'm now thinking more and more. I wrote down one of my subcategories is recession watch, because they're playing with some stuff here. And I'll go into the debt ceiling, the whole debt thing again here in a minute, but they're playing with a lot of different elements here. And when the governments get involved in labor disputes at this level, saying they back the increases, I'm not saying these people don't deserve more money and it should be negotiated. What I'm saying is this will be as they say, the nail in the coffin for the automakers. They've already got them making all these EVs. Every time I see an EV commercial, I just laugh to myself, realizing how ridiculous this entire so-called energy transition is. It's not going to transition. And I guess by the time that you figure out I'm right or wrong, I'll probably be dead and gone. So it's going to be a very long process, and they're going to keep pushing this thing down. But for the auto industry, folks, there ain't enough batteries. There's not enough electricity to charge them. There's not enough of anything, and all they're doing is bankrupting these companies. And that's part of why the workers want more money, right? There's less moving parts. There's, the whole production of the EVs is pretty bad. I think these guys are in trouble. I'll have to go back, maybe since I missed yesterday at the end of the stream, maybe after I go through the Russell tonight, we'll take a look at these auto stocks again and just kind of glance back. And not to mention, we've got interest rates still spiking. There's no downside. We even got an RTX sell yesterday and nothing. We just continue to see the yields just climb. They're just selling bonds. It's just getting uglier and uglier by the minute out there. Got Jamie Dimon going. We're not ready for 7% yields. But whether you're ready or not, Mr. Dimon, it's coming. And it looks like things could even get uglier from that standpoint. So let me try to tie some things together. I want to look at the economics that came out, economic reports that came out today. And we're looking at FHA housing was up, and that's interesting. Case-Shiller was up 0.1, but the FHA was up 0.8. Consumer confidence down a little bit to 103. New home sales at 675. I had that. I saw some people talking about 695. I think that was my expected number, right in line. And even though that's the lowest since March, and as I told you, there's a little tactic going on in the new homes where these guys are building them and renting out the houses. I'm still looking for some information on that to validate and to see at what level is that going on. So let's talk about Wednesday, and then we'll circle back to some of these other things that are going on here. But we're looking at Wednesday, mortgage index is coming out. Previous was plus 0.54. I suspect with these other numbers coming in, maybe that's a lower number. Durable goods minus 0.2, nothing really material. And we're going to be operating on market sentiment here, and that's not very good. We were printing down right into the 43 handle lower end. I believe 43.06 was the low there. I will tell you, I'm really trying to reconcile. I was getting ready for tonight's broadcast. I was just trying to reconcile this thing. I have Bloomberg TV over here on a 55-inch monitor. And just kind of for atmosphere more than anything, but they had Biden on there and just standing out in the picket lines. And this is a very, very bad thing. I talked about this a little bit, and I kind of blew it off, probably not going to get any traction, but I want to go down this trail just for a minute, is what if the other folks out there, and there are plenty of them, that are working and feel like they need a raise. I always use my Australian experience of 1980 as an example. When I was in Australia in 1980, each segment of the economy, they used to call it strike season when I was there, and the postal workers went out on strike, then the utility companies went on strike, and then the truckies went out on strike, and then it was like one after another, and depending on who got the best deal, the first guys, the postal guys, came back and went, wait a minute, we want more money. In the case of the U.S., at least there's a signed-off deal when they make one, and they can't go back and renegotiate the next day, which they could then. But this is the contagion that is a possibility here, which really could derail this whole economy pretty easily. It's just a disruption, right, of the flow and the cash flow and all that. So I'm starting to see these things. We got to watch this really close. So last thing, I will talk about these idiots in Congress and talk about the debt ceiling. And this is just the ongoing saga for these politicians to play a lot of games and actually not only raise the debt, but figure out how to spend even more money. And it's really crazy. I feel sorry for the folks in Staten Island and other things. This immigration crisis, we're ground zero here in Arizona. So we've known about this for years. Now that these people are being shipped all over the country, it's starting to be felt other places. And all of this stuff is disrupting everything, folks. So don't think that all these folks coming into this country is not costing a ton of money. I saw just in New York, and they're talking, I want to say I could be wrong, but like $24 billion in additional costs to the city, and they're getting $500 rooms. I don't want to go down this trail too far, but what I'm saying here is this is causing lots of disruption. It's putting additional cost on cities and all of us dealing with this crisis. And guess what? Spending this money and throwing it into thin air is still inflationary. So, I don't know what breaks. I used to think the Fed was going to break everything. Well, I think it will be the Fed, but it'll be the federal government now is in the process of really just trying to hammer this. And I think it's sort of ironic. I'll make this, maybe saying the quiet part out loud, is that these politicians actually don't think that their actions have consequences. And I'm not sure what we're dealing with here, folks, but when I look out at the landscape, been around these markets a long time, been on the planet for a reasonably amount of time. When I look at this stuff, I'm just wondering what's next. And what's possible here is a contagion in the strikes and people wanting more money. You've got the debt situation going crazy. Maybe that's why the bonds are getting hammered. And imagine if you're an advisor. I had a multi-hour meeting today with some folks in the advisory community. Another not competing firm, but another software company that were in town with me today. And all I can tell you, it's becoming obvious that everything that is going on here is starting to become material and starting to have effect across the board. And so if indeed we start to see some of these extra costs come in, some of these things that I'm talking about here start to affect the markets, it's going to be big, not little, because there's no reversing some of these things. I mean, you could go back to the COVID situation and all that, and that disruption. This is more, it isn't at the moment, but can be, and maybe the markets are looking at just that, are becoming more material from the standpoint, the more traction that this wage pressure starts to build and some other things could start to derail a lot of economic flow. And once that happens, then you got the debt, you got, everything goes on. And the bond vigilantes are just, they need bibs. They're drooling right now. To short these bonds looks so attractive. It doesn't look like there's any bottom. And we'll cover this in a minute. But anyway, I want to try to unwind out of this little rant that I'm in but the reality is that we could be looking at something much, much bigger. If you go back maybe 4 or 5 weeks ago, I thought this was going to be sort of a garden variety consolidation, pullback, would come back into some of the key moving averages. All of a sudden, tonight, I'm going to be talking about testing the 200-day moving average and some vulnerability off of that, which is also the 40-week average. There's a lot of things coming into play that I would say I wouldn't even talked about maybe 6 weeks ago. But now with what's going on, with everything we're seeing and basically the backdrop of what I just tried to paint, that picture, it all of a sudden is getting to the point where it's getting serious. And it could get so serious that something does start to break, and it's not going to be, maybe you could argue that the Fed raising rates did it, but we're now at the stage of this economic cycle that everything is starting to look really, really vulnerable. And I remember actually when I did the Meet Kevin interview, I remember telling Kevin that the thing that I was watching for somewhere in September, I said, then I'd be a little concerned about potential of a recession. I remember his response. He goes, that's what I'm hearing across the road, and that's fine. And I kind of pride myself and bringing these things. It's one thing, okay, I called it 6 months ago, but that doesn't, if you would have called that 6 months ago, the chances are you didn't participate in the uptrend. And instead, I was calling for the 46 handle to get hit, which we did. And I'm going to, we're talking about 42 handles right now on the market coming into play. So all of a sudden, I would rather have a little bit, keep it closer to the vest. And when we started to see this risk come into the markets, that's when we start to adjust our portfolios. Those of you that are institutional clients or using our portfolio software, you've already seen this market pulling back and the effects of this by us raising cash in the portfolios and start to get into what we call the protect mode. And once you get to that mode, now you're just kind of a spectator. You're sitting in the stands seeing who's going to win the game. And we're not there on the intermediates yet, but I think we're going to see a lot of attrition. Sorry to get into this little rant. I guess you give me a day off. I got extra energy. So let's go ahead and take a look at the database, and just remember it's a day removed. I don't have the results after today. They're going to be worse, is all I'll tell you. Let's go ahead and get into that. All right, so here we are. This is the short-term database for this morning, the open. We had 526 sell signals, 153 buy signals. We moved the needle down to 15.21. I told you typically in the full liquidation mode, you get to about the, let's just say around 12% is 12. It could go as low as 8. And I see somebody's talking about I'm bearish. You haven't seen my analysis yet, Syed, but I appreciate it. You know, you might be surprised. I might be buying. Pretty funny. I love it. So what I've been telling you for a while, we were going to fall back in here, and this is what the database was telling us. This database was almost 80% long. If we go back 10 weeks ago, 8 weeks ago, when we were printing up at 4,600, we were long. Then we saw everything starting to pull back, and basically the database has been spot on it and alerting us that there was short-term weakness. It's just that it continues to grow, and it comes from all this stuff I was just talking about. There, UAW thing was talked about, but now you got this ignorant president of ours out there participating in labor disputes and telling he supports the prices, which will bankrupt the companies. So the market sentiment probably couldn't be much worse. And so so I would just say from the database standpoint, I won't cover and talk about the intermediate. Intermediate database has pulled back. Most of our portfolios are 20, 30% in cash right now. And depending on what you're modeling, it could even be higher than that. But it's starting to look like things are going to pull back. So I'm not telling you to sell now. Let's wait for the technical part of the show, and so you can get a feel. And there's still some downside, but this is pretty much in the hole. But I'm going to show you some levels that are most likely going to be reached. And if this whole situation I just discussed gets out of hand, then expect something even worse. So let's go ahead and take a look at the technicals on the S&P. So the hourly chart is, I wouldn't say bullish, but it's definitely looking for a bit of a recovery as we come in overnight. We should see probably start to move up into the upper ranges of these moving averages on the hourly chart, 40, maybe 43.30 to 43.54. So you could buy some calls here and play this short-term move. We've also got a bubble bottom setting up here. So what we're seeing on the from the technicals is a bit of a potential, at least sideways to slight positive to the upside. And the key level to watch as things move higher is going to be coming into where the 21-day moving average is right now. Now, we also, just so you'll see in a minute, we got an STX buy signal for tomorrow. So we definitely have a lot of things leaning to the positive side. Right now, the futures are up 475 on the session, and I'll set up some things looking at the market grid. So, so some of the conversation we were just having here and talking about some of these events that the UAW situation, contagion for potential further wage increases in other industries and those type of things, those are going to, if those things start to happen, that's what's going to perpetuate maybe more of an intermediate move. For the moment, what we're looking at is really starting to see some of this. I love these what I call the bubble bottoms on that. You can see on the index here. So this is hourly, and so this is short-term stuff, right? So this gets us into maybe tonight into the London Open, where we could see some interesting numbers start to come up, at least maybe a little recovery rally. I did watch how we traded today off when we printed that new low. And it was some pretty good buying. We got like a 20 handle buy. So the buy was intraday earlier from that standpoint. And let's take a look at the daily. We still have daily PPM1 right now is minus 0.44. Anything under minus 0.22 25 is a trend mode, and we've been in trend mode down now. I'm just trying to get a number for you since we've been in trend mode down really since the September 20th. So the sell signals have been a while up, and now we're coming down, and like I said, we're starting to come in to potentially to challenge the 200-day moving average. Like I said, that's coming into play. That number right now is at 42.19. And I'm going to show you something because I'm going to bring up the weekly chart, because weekly is looking like potential. We printed S2 was 43.06 on the weekly. So we printed that today. We get through that, we have some other numbers to look at. Let's go ahead and look at the market grid, then we'll move on to the weekly here. So market grid shows S1 43.01. That would be a new low from yesterday. We got down to 43.05.5. And then, so S1 43.01, probably a decent number. R2 is 43.42. So there's a pretty good shot at potentially moving back up into that 40 handle, which lines up with that hourly chart as well. So let's, looking at the Augos, looks like they're trying to stabilize, but even going several days out, we're still negative. We're still in trend mode down. So there's going to be that 10 period moving average is going to be your key level on the downside. And I mentioned the 21. 21 is still not in the trend mode, but it is being forecast to get there in the next couple of days. So there's going to be plenty of resistance overhead. And about all you have, let's go to the weekly chart. So S1, R2 for tomorrow. We've got the STX buy signal. So what we're looking at here, and I've been talking about this is being forecasted anyway to be the final part of this week down. So we're getting very, very close to that 40 period moving average, which is very similar to the 200. Let me show you that value. So I'm going to flop back and forth. The 40 right now is at 42.41 is that value. Let me double check. Yeah, 42.41 is that number. If I go back just for a second to the daily to pick up the 200 is right now 42.20. So they're 42.40 to 42.20 would be basically the extreme. And if we just look at the market grid on the weekly, the market grid on the weekly shows that we got S2 4306.63, as I mentioned, 4305.50 was the low in today's session on Tuesday, and then on the next level below that is 4277, 4252. If you've been around this channel for a couple of videos, you know that I love clustered numbers. So starting at 4252 down all the way to 4220 is massive support. And we're likely, if we did print down there, that's going to be your buy the dip opportunity. But here's the thing, and as I was talking about, these guys, Senate, all this, I see somebody mentioning the government shutdown. Yeah, that could be effect, but let's face it, we already know the outcome. We've seen this thing for multiple years from that standpoint. And, but yeah, so, just my expectation is if you do print down that next level, 4277 is the magic number from my viewpoint, at least at the moment. And we should see a bounce out of there. That's the fib target on the downside. Now, one of the things that I talked about, if you recall, going back last week, and we closed below it last week, as I said, watch out for 43.97. If we take that out, then we're going down next level, probably to the 40. I don't think we go much below that. The current PPM on the 40 is at 20.2648. That's trend mode. So there is about a 60% probability for that level to hold, which is 42.41. And like I said, we've got fib targets. We got all kinds of stuff between 42.77 and 40. We even have some numbers down there at 42.20. But that's likely to be the bottom of this pattern. And then you see, at least from the August forecast, we see an improvement being forecasted as we start to get through the end of this week and get this out of the way. This is probably the capitulation, maybe an ABC pattern. Maybe we get an X and more sideways that crawls. We should stay above this 40 period moving average, which on the weekly, which is going to be that 200 day. That is most likely going to be the extreme. Not sure we're going to get there. There's a lot of support in this level, just slightly below here. Like I said, 42.77 being the key number. And then you got 50, I'm rounding numbers, 50, 40, 42.50, and then 42.20 as an extreme in this pattern. All right, let's go to the Nasdaq and let's take a look at something I talked about the other night. We have some downward fib targets here on the Nasdaq, and we broke through. Fib target 1 was 14,919, but the key targets to watch, which I talked about the other night, 14,480 and 14,212. And I think we have a shot at least printing fib target 2, which is 14,482. I think you'll see here on the daily, there's a good chance that we get some sort of rebound out of this level, just the formations that are setting up. But you look at the weekly, you see the algos coming into next week and beyond, which puts us into Q4. We'll set that up pretty good. So just know, I'm just looking at something really quick here. Yeah, so I'm not sure we'll have enough numbers. I'll probably wait till Monday's broadcast of next week to actually talk about the long term. I need the cash markets to kick in so that I have at least 1 day trading in that pattern to kind of calculate, especially for the quarterlies and the monthlies. I'm going to need that cash open to be able to do that. So I'll discuss a little bit on Sunday night some of the longer term aspects of what's going on. But more importantly, on Monday, I'll do the deep dive on the longer term view. Let's back up here and just go to the daily. So you see daily, this is kind of the final. We get this little downward trend going here, and it looks like we have a shot. And as we come into early next week, we've got what? We've got Wednesday, Thursday, Friday. We've got 3 days here. Looks like if we can hold some of these key numbers, especially those weekly numbers I just mentioned, then you got a good shot at generating some sort of bounce here from that standpoint. And it depends on how aggressive you are. If you see the right pattern setting up, then maybe we get you can play some TQs, triple Qs on the leverage for the trade, because I think the trade on the upside is going to be a little limited until there's a number of days and even weeks that formulate to start to set up a consolidation bottom. But we have all those things I talked about in the opening comments could still come into play and actually affect market sentiment to print down into these lower levels that we're looking at here. So, but this overall pattern looks to me, we're coming right back. I'm just bringing up a cursor here, coming right back into the 14, we'll call it 550 levels there to a low 1400s is going to be probably a support range here. So I would look for the potential for some kind of bounce or something out of here. If we print through these numbers, then there's another level. And I think the guidance that I would use, and this is what I will do, is I'll be watching those numbers that I mentioned on the S&P. They seem to be very clear, and that cluster between, like I said, 42.77 down all the way down to 42.20. These are rounded numbers. There's multiple, I believe there's 4 potential support levels, and there's also angle of attack. There's a big argument that this will at least be somewhere at the extremes if we print down a little bit lower, and maybe some of this market news will be the driver of that. So we'll cover the Russell. This is the cash. I just continue to see this market just get hammered. I've been talking about all the zombie companies that are in the Russell, not to mention, as we look at yesterday, all the banks are getting hammered again as well. You're looking at KRE. Basically, I just round up, say the banks in general, no matter whether they're community or regional, whatever, they were all down roughly about $1.50 plus. So there's definitely a lot of downward pressure from the standpoint of what's going on, especially KRE and the community banks. There's a lot of those in that Russell index. And that's just has zombieized anything that's possible from that standpoint. So let's take a look at, let's go ahead and just move on to the interest rate. You know what? I mentioned something earlier. I'm glad I caught myself. Let's go through a couple. Let's take a look at GM and Ford. I want to look at those. So we're going to do a couple stocks. I'm not going to do any more than that. But let's just take a look at this thing. And the other day it was looking like maybe we could hold, but let's stick with a weekly forecast here. Market grid wise, yeah, nothing's really changed. I think I did this last week. Looks like we have some downside, but it is limited maybe to around the 30 handle on GM. Let's put up Ford. Okay, so yeah, as we look at Ford, this is weekly Ford. Really, it looks like maybe this stock is going to hold here. I'm not seeing the disastrous collapse going to zero mode. So who knows? Maybe this strike will work out, and all of these concerns. The problem with sometimes bringing in these concerns, if you think about it, if you listen to anybody that was telling you there's going to be a recession, you miss this entire rally if you believed in that narrative that was being put out there beginning of the year, how this was going, the yield curve inversion was going to cause that. And maybe it still will, but it wasn't going to cause it right then. And that was the, that was the narrative that was out there, that if you play some of these fundamental and these ideas out, they just don't matter. The technicals usually win over for most of the time. And so somebody's putting something out there on the timeline. Let's just take a look at this. And this is, I'm putting out there really quick here. So this is Ford all the way back to 1968, and just trying to get a feel. But I would say since 2010, we've been in this $12 range. If you remember, in 2008, I mean, we got down to $2, and that was the buy of a lifetime. It was funny. One of my neighbors actually comes up to me. He knows what I do, and he goes, and I couldn't avoid it. I had to buy Ford at $2. That's just, it's there. I'm even going to lose $2 or it's going to go up. And obviously it did quite well out of the 08. We went from $2 all the way to $15, $18 on the upside. But this thing has been stuck for a while, and this is the monthly chart. This will give us even a better view. I did something interesting. I just put this on a quarterly chart. So yeah, we've just been locked in this range for a while. $20 down to $5, and it looks like right now on a longer term grid viewpoint, we're really trading down potentially towards the bottom end of this range here. So we'll see if it holds. But I wanted to take a look at that. All right, folks. I'm just kind of left this 3-month chart up of, this is the 10-year, just to get some perspective, right? You can see here's when I started in the market in the 1980s. I started in 79, and we got to some the 10-year here. I'm just looking at 15 3/4. I won't tell you any stories, but I got a great story on this. But we've declined, and we went sideways here since the '08 crisis, and finally we're seeing, if you look at the big scheme of things, and this is my argument that I've been talking about, is we're just back into the range that we were in 2006, and we're just back into that normalization. And I could even go, this chart doesn't go back a long ways, but it does. If I go back to the 70s, and even in the 75, we were at 4.55 yield on the 10. So, we obviously saw this spike, but for the most part, we're back to what's normal ranges. And I've been arguing this on the channel for a while, and this kind of really brings that into view. So let's go ahead and go back to reality here. And what we're looking at is, this is the 10-year. We almost, listen folks, these numbers seem ridiculous when I was talking about them the other day, but fib target 2, 462, we printed up to 456, and it looks like there's more juice in this thing, otherwise more selling to come into the bonds. And there's 2 targets to pay attention to. This is daily, 4.62 and 4.71. Let's convert this over to a weekly chart. And now, I can tell you, and you've been on the channel for a while, if we go back on Monday, May 1st, we got a new Fibonacci target for the 10-year. The market was at 329 low, the close 344 on May 1st of this year. And the fib targets that came out were for 401, 429, and basically 4.5, 4.47. Seemed absolutely ridiculous. And this is why when I go through and we have these new fib targets, I show these to you, because it ends up they were spot on. It turns out that we have now exceeded fib target 3, 4.47 with a high of 4.56. So, and if you look at the angle of attack and the slope here on a weekly, it's suggesting we're going to go up into November. And if you just follow this 10-period line here, we're talking about the 10-week moving average moving up towards the 450. So typically there's a premium above that level, meaning that we could see 475, we could even see 490 on the 10-year during this period. So we're a long ways from this thing being done. Having said that, there is possibility that we could come back and retest that line, which is that 10-period moving average, which right now it's at 424, and by the week it's going up seven ticks per week, and the algos are suggesting it's going to stay pretty much on that angle of attack. So it'd be 431, 438, 450, 45, and then 50 in over the next month or so. So you're going to have lots of support down at the 425 to 450 level, just based on this angle of attack and what's being forecast as we go forward. And if you look at PPM1, folks, over in the far right, it's in the white. I'll put a cursor over by there. That value right now is 1.73. 0.25 is a trend. This is, if you recall the chart that I bring up all the time, this is the extended move. When we get above 1.6, that indicates that the move will be elongated. Otherwise, it will continue to crawl along that projected line for longer than you can imagine. And that's exactly what it looks like is going to happen. So I try not to say these words together, but the higher for longer thing is, I've been telling you for a while, not only higher for longer, but very much longer, which would put us, I think, well beyond 26. You could be talking maybe a decade. And that's why it's interesting that we looked at that 3-month chart and go back to previous periods of time of economic activity and risk. And if you go back to 74, 76, there's a lot of things that were going on then. That was stagflation days. And, Jimmy Carter was president when around, I guess it was 76 when he came in. But all of these things were just perpetuated by a high inflation was kicking in. There was a lot of similar type things, but we're really, of course, we went to 25%, 20 to 25% working on the upside from the standpoint of what ended up coming out of those scenarios that were being played out in the 70s and the mid 70s. So, this is something really, really big here, folks. That's all I'm telling you. I knew, I saw these forecasts. All of a sudden, now we're making a new all-time high. Not all-time on this chart, but we're looking at prices and getting down pretty cheap. But we're still not seeing any indication that this thing is about to be over. So let me get rolling downhill here a little bit so we can finish the stream. I'd like to keep it within the hour. That's a long time for a lot of folks, but that we're going to push for that. Oh, I do want to show one thing. I want to bring up the 2-year before I move on. And what you're going to see is the 2-year is still continuing to be flat from the standpoint of what's going on with the algos. It's starting to round off a little sooner. And maybe when we go through next Monday or something, maybe I'll go through and do a yield curve analysis, but it's still the same analysis that I have. I'll just mention it, is that the short end of the market is going to start to flatten off and just stay stable on the front end, and the back end is going to continue to rise, which will flatten. The yield curve is, in technical terms, is starting to just completely go flat. And where we end up with the front end of the curve being held up by Fed funds, 13-week T-bills printing up above the 5.52 plus, and then we see it just moderating off until there's a little hump in the beginning of the curve, and then it just flattens out. So I'll leave you with that visual picture from that standpoint. But that is that's going to be the ultimate thing, and then what we'll probably see at some stage is that the front end of the curve will start to drop, and then we'll get into a normal curve where the front end of the market is lower than the back end, and that's just going to take some time to get to that place. But it's going to be an interesting trek, to say the least. All right, so crude oil also has that upward slope. I've discussed this, I know. Every time I mention it, it kind of comes up. But it's interesting that when you look at the 10-year notes and then crude oil, the chart formations are very, very similar. I don't know why that is, but you can see this further projections of higher prices going down the road. As we come into October, November, there's just that higher slope, just like with the interest rates, and then it starts to moderate a little bit. And yeah, I see somebody mentioning $33 trillion worth of debt on 5% a year, 1.6 trillion rate payment. and what possibly could go wrong. Couldn't agree with you more. And that's one of the scenarios. I've mentioned this before, just to backtrack just for a minute but these crude and the 10-year charts look similar. That's something that I've been talking about for years because it's appropriate, is at what stage does that debt ceiling I used to joke, well, when it was 19 trillion, is it going to be 20 trillion, 25 trillion? Well, we know now we're at 33 trillion and we're still going. So at what point does too much become too much? And there's some other issues. Meanwhile, back to crude oil, what we're looking at here is just that upward slope. I just think it's interesting that the interest rates and the crude are really seem correlated in some kind of weird kind of way. All right, on to gold. This just can't be making Peter Schiff happy at all. We're trading down to the lower end of the week. I've been talking about these fib targets down here that have been hanging around. This is what I was showing you on the interest rates going back into May. This is why I don't ignore these situations, because we're looking at a projection down to the 200-week moving average, which is roughly 1820, 1840. It's a rising average, so it's moving up over time. But it just, everything is pointing to this market to come down. The only thing that's not is the algos are suggesting we're going to stay negative, but it's going to moderate as we come in to November. We'll have to see what happens. I think this market is very vulnerable to the downside. All right, so off the Bitcoin. Interesting, if you recall the comments I made the other night, I think we're going to continue this is a weekly chart on Bitcoin, continue to trade along that upward slope 40 period moving average. That right now is at 26,247. We did print down to 26 even, 25,977. And last trade here, 26,153. So that's going to be your number to watch. And it does look to me like we're going to be able to stabilize in the next week or so. Let's take a quick look at the daily, and we'll be done about 5 minutes to 1 hour broadcast time. So we're pretty close to getting done here, folks. But the bottom line is, this is giving us a little bit different picture. And one of the things I talk to you about all the time is when you get this collapse in the market grid numbers where the ranges get narrower and narrower. We had a little expansion. You can see these bubbles. Now what we're getting is we have a downward slope 10, which is telling us it's only at 0.15, so it's not in the trend mode. And PPM2 is flat and PPM3 is flat. So this is a stage where if there's going to be what I call a pivot out of this pattern, that this would be the place to happen. The positive that's going for this is the value of that 40-week moving average on the chart right now on the weekly. The daily is projecting a more negative picture, but the fact that we have these fib targets here at the moment aren't really being confirmed by the action in the PPMs. PPMs, you can see down below here, PPM3 is turned up. PPM2, which is tracking to 21, is actually a little positive, and then we have a negative 10. So you've got basically this sideways range, and we're just trading in this range. So I think we're several days away from, that they don't look like there's I guess anything exciting that's likely to happen as we just look at the algos and what's being projected is really flat and we get in this pivot. I would stick with the analysis on the weekly. That'll probably have a much higher accuracy. Okay, folks, that's going to do it for tonight. Thank you. Quite a few people showed up today. Thank you so much. I am working on something. I'm going to put a month-end special on the indicators. If you haven't bought them, they're still on the indicators. KendallReport.com/indicators will still get you if you if you bought the previous version, you'll get like a super deep discount. You'll see when you go there. If it doesn't show a deep discount, then don't put the order in. Let us know, and we'll fix it for you. But we'll refund any overcharge. Don't worry about that. There's no problem there. I just want to get these out. I'm still gearing up for coming into October, working on putting this symposium together. I'm actually working on some bodies to bring into the room right now because I have some interesting things I would like to achieve. And then I'm hoping that we're going to put it out there for maybe February, March of next year, doing a live event in Vegas will be the target. And so I'm looking forward to that. The weather's good. It's easy to get to. And I'll have to watch out, though, because I think that they're doing a Super Bowl this year in Vegas, so you don't want to be anywhere around that. But anyway, folks, thanks for watching. Thanks for your patience. I've got lots of things I'm dealing with around here and in my world. So just know I'm showing up every day I can. I appreciate it. And we'll talk to you tomorrow night at the same time. See you then. I agree with you, Chris, about the Smurfs. I think we're down to one loyal Smurf, which is Bo. So let me know if you want to be a Smurf. Or come up with a cool name. We'll come up with better names. Yeah, Todd, I like the spring training aspect as well. That would be fun. That's probably safer than going to Vegas, but it's really usually cheap, easy to get to Vegas. So anyway, we'll talk soon. Yeah, got it, Bo. Thanks, man. Have a safe trip.